After studying this module, we shall be able to know the concept of directing and controlling, learn definitions given by different authors, elements of directing, process of controlling, techniques of controlling, evaluate the importance of directing and controlling to achieve organizational goals.
Direction is the vital function of the management. It pledges with the human relations. It is a managerial function of guiding, motivating, and leading and supervising the subordinate to attain the desired objectives. Without appropriate direction, employees will go static and tedious. It is the vital phase of the management requiring leadership and managerial skills critical to achieve the goals of the organization. Direction is very noteworthy function of the management which initiates from the top level managers to the supervisors in relative to a consigned task which is given after division of labor and consequent delegation of authority to each employee according to his skill and intelligence to outperform his contenders at the work in a specified arena of a given task. This makes the directing a fundamental facet of organizational management. Directing is telling people what to do, seeing that they do it at the best of their capabilities, and getting all the members of the group to want and struggle to achieve the objectives of the enterprise.
According to Pierce and Robinson, directing is a managerial task which involves the responsibility of managers for communicating to others what their roles are in achieving the company's plan. It is helping all the members of the group to strive to achieve the objectives of the enterprise. Let us now learn the nature of directing. Directing function is a pervasive and continuous activity requires at all the levels in the organization. Directing function is linked to subordinates and hence it is related to human factor. Human factor is comprehensive in nature and activities are unpredictable. Thus, direction function becomes crucial. Direction is an imperative function dealing with the human beings who are erratic by nature and conditioning the people's behavior towards the goals of the enterprise is what the executive does in this function. Direction function is carried out by all managers and executives at all levels throughout the working of an enterprise, and a subordinate receives instructions from his superiors only. It is a significant function that helps in translating plans into performance. Without this function, people become quiescent and physical resources are worthless.
Directing is a pervasive function. Directing is necessary at all levels of business. Managers at every level provide guidance and inspiration to subordinates. Directing is a continuous activity. Direction is a continuous activity and it takes place every day in all organizations, all the way throughout the life of organization. It involves human factor. Directing function is linked to subordinates and hence it is related to human factor. Human factor is comprehensive in nature and activities are unpredictable. Thus, direction function becomes crucial. It is a creative activity. It is a significant function that helps in transplanting the plans into performance. Without their function, people become quiescent and the physical resources are worthless. It is an executive function. Direction function is carried out by all the managers and executives at all levels throughout the working of an enterprise, and a subordinate receives instructions through his superiors only. It involves delegation. Direction is an imperative function dealing with the human beings which are erratic by nature and conditioning the people's behavior towards the goals of the enterprise in which the executive does in this function. Delicacy is required to tackle the human behavior.
After learning the nature of direction function, let us now have a glance on the importance of directing. It forms coordination among the employees. Directing motivates the staff to do their task perfectly with determination. Directing also helps in bringing changes in the structure of the organization. Directing helps in building equilibrium in the organization by motivation, support, harmonization, sponsorship, etc. Let us now go through the elements of directing. First is the supervision, which means observing, instructing, and guiding the subordinates in their tasks to make sure that both plans and measures are implemented. Next is leadership. A leader is one who guides and directs people. He gives the efforts of his followers an alleyway and justification by influencing their conduct. Next is motivation. Motivation is the process of inspiring people to action to achieve desired results. Last but not the least is communication. It is exchange of information and opinions between two or more persons for universal understanding. Let us now discuss the principles of direction function. Direction must help every individual in the organization to give his utmost potential for accomplishment of organizational objectives. The individual's objectives and organizational objectives must be in harmony with each other. Good directing should convince employees that organizational objectives are in their own interest. Subordinates in the organization should receive instructions from only one superior, or else it may create perplexity, ambiguity, and conflict and disorder in the organization. The motivation, supervision, communication, and leadership should be pertinent with the approach and want of the employees. The two-way communication is the most effectual means of securing cooperation of the subordinates because it provides them a chance to convey their feelings. An informal organization subsists within the formal organization structure. So managers must design informal structure also for getting accurate and authentic feedback. A manager, by becoming a good leader, can make direction effectual with the faith and buoyancy of his subordinates. Lastly, mere giving of an order is not enough. Managers should follow it up by reviewing to achieve the organizational goals efficiently. Let us now move on to the next concept, that is controlling. Controlling is a fundamental managerial function. It is the process of ensuring the actual activities crammed to planned activities. Controlling is defined as a measurement of actual performance and expected performance and taking corrective action. Its intention is to make sure that actual performance is unfalling. It helps to ensure that objectives and accomplishments are consistent with one another throughout the organization. According to Kunz or Donnell, controlling is the measurement of accomplishment against the standards and the correction of deviation to assure attainment of objectives according to plans.
Controlling is a fundamental managerial function. It is a process of ensuring the actual activities crammed to planned activity. It is a vital function for all levels of management. It ensures the right things are done in the right manner at the right time. Controlling is defined as a measurement of actual performance and expected performance and taking the corrective action. Its intention is to make sure that the actual performance is unveiling with the plans. In fact, control helps the managers to screen the efficacy of their planning, organizing and directing activities. According to Reeves and Woodward, control refers to the task of ensuring that activities are producing the desired results. Control in this case is limiting to monitoring the outcome of activities, reviewing the feedback information about this outcome, and if necessary, taking corrective actions. According to Terry and Franklin, controlling is determining what is being accomplished, that is, evaluating performance, and if necessary, applying the corrective measures so that the performance takes place according to the plans. According to G.R. Terry, controlling is determining what is being accomplished, that is, evaluating the performance if necessary, applying corrective measures so that the performance takes place according to the plans. According to Henry Fioll, controlling consists in verifying whether everything occurs in conformity is with the plans adopted, the instructions issued, and the principles established. It has for its object to point out the weakness and the errors in order to rectify them and prevent the recurrence. According to McFerrell, the presence in a business of that force which guides it to be predetermined objectives by means of predetermined policies and decisions.
Let's quickly go through the characteristics of controlling. Controlling is a significant managerial function. If controlling is debarred, all other functions of management are rendered worthless. Control does not mean any activity which is performed only for once, but it is needed at all times. Under controlling, the improvement has to be evaluated incessantly. It is a pervasive function, that is, it is implanted at each level of an organization. Controlling always looks to the future so that follow up can be made whenever requisite. Without planning, controlling is a futile exercise, and without controlling, planning is worthless. Planning presumes controlling, and controlling succeeds planning. Controlling is a function which comes out once the performances are made in conformity with the plan. That is, it is an end process. As we now know the concept of controlling well, let us now have a glance on the process of controlling. First step involves the establishment of standards. Standards are the plans which have to be attained in the course of business function. They can also be known as the criterions for judging the performance. Next step is the measurement of performance, which may involve the measurement of quantitative and qualitative performance. After measuring the actual performance, it is compared with the standards to find out the deviations. Managers has to find out deviations which are critical for business. Trivial deviations can be ignored. Once the causes and extent of deviations are recognized, the manager has to perceive those errors and take remedial measures to remove those deviations.
Standards are the plans which have to be attained in the course of business function. They can also be known as criterions for judging the performance. Standards are classified in two categories. The standards which can be measured and expressed are called as measurable standards. They can take the form of cost, output, expenditure, time, profit, etc. Non-measurable standards are which cannot be measured financially. For example, performance of a manager, divergence of workers, their attitude towards a concern. Controlling becomes simply though establishment of these standards becomes controlling function is exercised on the basis of these standards. The next major step in controlling is to measure the performance. This helps in finding out the deviations. Tangible standards are easy to measure as they can be expressed in units, cost, money terms, etc. On the other hand, qualitative measures become difficult when performed of management have to be measured. Comparisons of actual performance with the planned targets is very important to find out deviations. Deviations are the gap between actual performance and the planned targets. The manager has to discover two things: extent of deviation and the cause of deviation. Managers has to find out those deviations which are critical for business. Trivial deviations have to be ignored. Major deviations like replacement of technology, selection of workers, superiority of raw material, rate of profits, etc. have to be looked upon willfully. Once the deviations is acknowledged, a manager has to think about various grounds which led to deviations. Reasons can be flawed planning, lack of coordination, defective implementation of plans, or ineffective supervision and communication, etc. Once the causes and extent of deviations are recognized, the manager has to perceive those errors, take remedial measures to remove those deviations, and there are two alternatives. Either manager can take the corrective action of deviations which can occur, or the manager can amend the targets. Follow-up is an essential step as it is only taking corrective measures a manager can put into effect controlling function. Control techniques offer the managers and type the amount of information they need to access and examine the performance. The information from various controls must be customized to a precise management level, department, unit or operation. To ensure inclusive and unwavering information, organizations frequently use standardized documents like financial status, project reports. Each area within an organization, nevertheless, uses its own explicit control techniques.
After learning the controlling process, now we will learn the traditional as well as the modern techniques of controlling. As far as traditional techniques are concerned, traditional techniques are personal observation. This involves the observation of actual functions at the place of work. It is the oldest method of control. Such a method has psychosomatic impact on the employees, making them try harder. Financial statement. Under this technique, profit and loss account and balance sheet is prepared. Current figures are then compared with the previous years and also with other organizations. It helps to comprehend the profitability, solvency, and liquidity of the organization. Next traditional technique of controlling is standard costing. It is a technique of cost accounting which evaluates the standard cost of each product or service with the real cost to verify the competence of the operation so that any counteractive action may be taken instantly. Next is budgetary control. Under this technique, budgets are prepared and budgetary control is done from all facets of a business such as earnings, expenses, production, capital, and revenue. Last traditional technique is the break-even analysis. It is a graphical representation of the interrelationship between cost and volume of production and profits. Let us now move on to the modern techniques. First is the return on investment. ROI is a tool to improve financial performance of the organization. It helps the business to evaluate its present performance with that of the previous year's performance. It also helps to carry out inter-firm comparisons. It also shows the areas where curative actions are required. It is also well known as return on capital employed. It signifies how efficiently resources have been utilized. Second is the MBO, that is management by objective. The main objective of this technique is to increase the performance of the organization by ailing goals and the objectives of the subordinates.
In business, the purpose of the return on investment metric to the measure per period rate of return on money invested in an economic entity in order to decide whether or not to undertake an investment. It is also used as an indicator to compare the different project investments within a project portfolio. The project with the best ROI is prioritized. ROI and related matrices provide a snapshot of profitability adjusted for the size of investment assets tied up in the enterprise. ROI is often compared to expected or required rate of returns on money invested. Return on investment is not net present value adjusted. Most school books describe it as a year zero investment and 2 to 3 years income. Marketing decisions have obviously potential connection to the numerator of ROI, that is profits, but these same decisions often influence assets, usage and capital requirements, for example, receivables and inventories. Marketers should understand the position of their company and the returns expected. In a survey of near 200 senior marketing managers, 77% respond that they found the return on investment metrics is very useful. Return on investment may be calculated in terms of the financial gain. For example, the social return on investment, that is SROI, is a principle-based method of measuring extra financial value, that is the environmental and social value not currently reflected in conventional financial accounts relative to resources invested. It can be used by an entity to evaluate the impact on stakeholders, identify ways to improve the performance and enhance the performance of investments. ROI is a tool to improve the financial performance of the organization. It helps the business to evaluate its present performance with that of the previous year's performance. It helps to carry out the inter-firm comparisons. It also shows the areas where curative actions are needed. It is also well known as return on capital employed. It signifies how efficiently resources have been utilized. It makes the management conscious of the wastage and ineptitude. Management by objectives is a systematic and structured approach that allows the management to focus on achievable goals and to accomplish the best possible results from accessible resources. Employees get chance to identify their own objectives. This concept was developed by Peter Drucker in 1954. The main objective of this technique is to increase the performance of the organization by aligning the goals and objectives of the subordinates. Management audit is a general and scientific assessment of quality and management. It is an inclusive and productive review of the performance of the management. It helps in reviewing all facets of organization, which in turn helps to perk the performance and guards the organization from delusions. Management Information System, that is MIS. Management needs accurate information in order to control the organization properly. They require information about in-house working of the organization and also about the peripheral environment. Information is collected incessantly to discover the problems and find out the solutions. MIS gathers the data, processes it and provides it to the manager. MIS may be manual or computerized, and with the help of MIS, managers can delegate authorities to subordinates without the trailing control. Program Evaluation and Review Technique, that is PERT, and Critical Path Method, that is CPM. Both these methods are oriented towards achieving the healthier management control of time spent in finishing a project. Under both the techniques, a project is divided into activities, and then all activities are integrated in an extremely rational sequence to find out the shortest time required to complete the entire venue. Conversely, the distinction between the two is the PERT focuses on the time, whereas CPS focuses on the cost. Management by objectives, that is MBO, also known as management by results, is a process of defining the objectives within an organization that management and employees agree to the objectives and understand what they need to do in the organization in order to achieve them. The term management by objective was first popularized by Peter Drucker in his book 1954, The Practice of Management. The essence of MBO is participative goal setting, choosing course of actions and decision making. An important part of MBO is the measurement and the comparison of employees' actual performance with the standard set. Ideally, when employees themselves have been involved with the goal setting and choosing the course of action to be followed by them, they are more likely to fulfill their responsibilities. According to George S. O'Dern, the system of management by objectives can be described as a process whereby the superior and subordinate jointly identify its common goals, define each individual's major areas of responsibilities in terms of results expected of him, and use these measures as guides for operating the unit and assessing the contribution of each of its members.
Third is the management audit. It is an exclusive and productive review of the performance of the management. It helps in the reviewing all facets of the organization, which in turn helps to perk up performance and guards the organization from delusions. Next is Management Information System. Under this technique, information is collected incessantly to discover problems and find out solutions. MIS gathers data, processes it, and provides it to the managers.
Management audit is a systematic examination of decisions and actions of the management to analyze the performance. Management audit involves the review of managerial aspects like organizational objectives, policies, procedures, structures, control and system in order to check the efficiency or performance of the management over the activities of the company. Unlike the financial audit, management audit mainly examines the non-financial data to audit the efficiency of the management. Somehow, audit tries to search the answer of how well the management has been operating the business of the company. Is the managerial style well suited for business operations? Management audit focuses on the results, evaluating the effectiveness and suitability of controls by challenging the underlying rules, procedures and methods. Management audit is assignment of methods and policies of an organization's management in the administration and the use of resources, tactical and strategic planning, and the employee and organizational improvement. Management audit is generally conducted by the employee of the company or by the independent consultant and focused on the critical evaluation of management as a team rather than appraiser of the individual.
Last is PERT and CPM. Both these methods are oriented towards achieving healthier managerial control of time spent in finishing a project. Under both techniques, a project is divided into activities and then all activities are integrated in an extremely rational sequence to find the shortest time required to complete the entire venture. Conversely, the distinction between the two is that PERT focuses on time, whereas CPM focuses on the cost.
The Program Evaluation and Review Technique, commonly abbreviated as PERT, is a statistical tool used in the project management which was designed to analyze and represent the task involved in completing a given project. First developed by the United States Navy in 1950, it is commonly used in injunction and conjunction of the critical path method. PERT is a method to analyze the involved task in completing a given project, especially the time needed to complete each task and to identify the minimum time needed to complete the total project. PERT was developed primarily to simplify the planning and scheduling of large and complex projects. It was developed for the US Navy Special Projects Office in 1957 to support the US Navy Polaris nuclear submarine project. It was able to incorporate uncertainty by making it possible to schedule a project while not knowing precisely the details and durations of all the activities. It is more of an event-oriented technique rather than a start and completion-oriented, and is used more in projects where time is the major factor rather than the cost. It is applied to very large-scale, one-time complex, non-routine infrastructure and research and development projects. An example of this was in the year 1968 Winter Olympics in Grenoble, which applied PERT from 1965 until the opening of 1968 Games. This project model was the first of its own kind, a revival for scientific management founded by Frederick Taylor, that is Taylorism, and later refined by Henry Fayol, that is Fordorism. Dewpoint's critical path method was invented at roughly the same time as PERT. The critical path method is a project modeling technique developed in the late 1950s by the Morgan Walker, Dewpoint and the James Kelly and the Remington Rallen. Kelly and Walker related their memories of the development of CPM in 1989. Kelly attributed the term critical path to the developers of the program evaluation and review technique, which was developed at the same time by Booz Allen Hamilton and the US Navy. The precursors of what came to be known as the critical path was developed and put in practice by Dewpoint between 1940 and 1943 and contributed to the success of Manhattan Project. CPM is commonly used with all forms of project including construction, aerospace and defense, software development, research projects, product development, engineering and plant maintenance among others. Any project with this interdependent activities can apply this method of mathematical analysis. Although the original CPM program and approach is no longer used, the term is generally applied to any approach used to analyze a project network logic diagram.
Summarizing all that we have learned in this module, we can say that directing is telling people what to do and seeing that they do it to the best of their capability, and getting all the members of the group to want and struggle to achieve the objectives of the enterprise. And controlling is measurement of actual performance and expected performance and taking corrective actions. Its aim is to make sure that the actual performance is unfalling with the plans.
Directing is a telling people what to do and seeing what they do it to the best of their capability, and getting all the members of the group to want and struggle to achieve the objectives of the enterprise. Directing is a pervasive, continuous and executive function. Direction initiates an action, forms coordination among the employees, helps in motivation, facilitates changes in the organizational structure and helps in building equilibrium. The major principles of direction function are maximum individual contribution, harmony of objectives, unity of command, appropriateness of direction technique, managerial communication, use of informal organization and follow-up. The four essential elements of direction function are supervision, leadership, communication and motivation. Controlling is defined as a measurement of actual performance and expected performance, and taking corrective action. Its main aim is to show that actual performance is unfailing with the plans. Control helps the managers to screen an efficacy of planning, organizing, directing activities. Controlling function is an end process which is pervasive and linked with planning. Controlling process involves 4 steps: establishment of standards, measurement of actual performance, comparison of actual performance with the standards and taking the remedial actions. The traditional techniques of controlling and observation, financial statements, standard costing, budgetary control and break-even analysis. Modern techniques involved are ROI, MIS, MBO, PERT, CPM and management audit.